Recording now. All right. So let me share my screen. Oh, and after we look at notes receivable, I'm going to show you the calculations for accounts receivable turnover and days to collect. So it's similar to what we saw in inventory, where we said inventory turnover, how many times a year do we turn over inventory, and how many days of inventory are on hand. And if you remember, we talked about how for a store that sells salad stuff, you wouldn't want that inventory sitting around for more than a few days. But a store that sells canned goods, that inventory could be 30 days old and it wouldn't be a problem. So the same will be true in accounts receivable. Okay. All right, a promissory note. So we are on page 27 of your course pack. A promissory note is a written promise by your customer to pay a specified amount of money on demand or at a definite time. It's typically used in two situations. There's a third situation, but these are the ones we mostly use. One, when individuals and companies lend or borrow money. In this chapter, we're talking about lending money. And the second situation is in settlement of accounts receivable. Okay, so if a customer says, hey, I cannot pay this bill on this day, but I can pay it in 3 months, can you convert this accounts receivable into a note, which means the customer is agreeing to pay an agreed upon interest rate. Okay. And the third reason that we don't usually get into is if the company has certain limits on how much they will let an invoice go out for. For example, we only bill customers up to 20,000 as accounts receivable, after which it's got to be a note with interest. So we don't get into that much in this chapter. Okay. So look at page 27. So the goal is, when is a note due? So it depends. Is the note expressed in terms of months, or is the note expressed in terms of days? So if a company issues a note issued on July 21st, and the note is worded, this note is due in 3 months. What is the day that this note is due? Put it in the chat. So this month, I issued the note on July 21st. When is the note due? It's a 3-month note. Okay, I'm watching the chat. Got one. Brianne, do you have a revised one? Yes, got it. Okay.
Yeah, sorry.
I figured it was a typo. All right. October 21st. 3 months is going with the day of the month. Okay. Now, if you express the note in terms of days and you said this was a 90-day note, then you count out 90 days from July 21st. So, and this is how you do it. You take the end of the month minus the issue date. That counts as 10 days. August is a 31-day month, so you add 31 days. September is a 30-day month, but that only brings us to 71 days. So we need 19 more days to get to the 90 days. You guys all understand that? You want to go through that again?
Can you go through that again?
I sure can. So if I issue a note July 21st and I say, Peter, you have to pay this note in 90 days. The day you have to pay this note is going to be 90 days from July 21st. And the way you count those days is shown right here. So we're saying how many days out is 90 days. So here we're still at 71 days. We need 19 more days to get to 90. Okay, so we're saying the note was issued July 21st. July 31st minus 21st is 10 days. And so in order to do this, you have to know how many days are in a month. And I can't tell you how many times a student has come up to me during a test and says, does July have 30 days or 31 days? And that's a fair question, frankly. Who keeps track anyway? But I happen to know that August has 31 days, so that counts 31. September only has 30. So that brings us to 71 days. So the note's not due yet on September 30th. I need 19 more days to get to 90 days, and that'll bring us to October 19th. Okay, so you just count out 90 days. All right, so this is what you guys are looking at. Nope, this is similar to what you guys are looking at on page 27. Okay, so we have players involved. We have characters involved in notes. Okay, so at the bottom of your page on page 27, let's just switch to that. No, let's not. I want to stay on this for a sec. Okay, so looking at your note, we have the dollar amount of the note. We, of course, have the issue date of the note. In this case, it's May 1st, 2011. Here we have the payee, and here we have the maker. And that's not maker. If you like Dune, that's not the makers in Dune. These are related to loaning money, not giant sandworms. But so here's the dollar amount of the note again, $1,000. Here's the interest rate, super high interest rate. Although with inflation right now, our inflation rates are starting to creep up toward that. Okay. So who borrowed the money? So the payee, Wilma Company, issued the promissory note, and the payee is the one who's going to book the note receivable. So we would be, if we booked a journal entry, we would be doing Wilma's books because we're studying notes receivable. The maker, or another name for maker, is the payor. The person who's going to have to pay back the note is Calhoun. For them, if we were doing their books, we would be recording a note payable. Okay. So look at the note in your course pack, and I want you to identify who's the borrower, who's the lender, what's the period the note is for the money that was borrowed, when is the due date, and how much will be paid back on this note. Okay, so take a minute and do that. So we're changing the note a little bit, not much. And I want you to answer these questions in your course pack. Who's the borrower? Who's the lender? Okay, so take a minute and then we'll discuss them. You guys need more time? Or are you good? Put it in the chat. Okay. So I want to know how much will be paid back, and that includes interest. So you got to figure it all out. Okay, I'm going to ask you some questions. Put the answers in the chat and direct message me. Who is the borrower for this note? Who's the borrower? Yes. Thank you. You are correct. You can stop. The borrower is cheesecake. Now it makes me want cheesecake. Okay. We Cheesecake make commitments to pay. So pretty obvious there. Okay. Who's the lender? Who is loaning the money to Cheesecake? That's correct. It's Chen. I wonder if I can I write that in there? Yeah, I think I can. Oh, it's going to look weird. Okay, never mind. Cheesecake. How long is the money being borrowed? And when is the due date? Correct, correct, correct. When's the due date? Yeah, Cole, you're correct. July 1st, 2016. It's a 2-month note, so it's just, we issued the note on 1st of May. It's 2 months, so June, July, done. Okay, no days to count. All right, how much will be paid back? Okay, I'm getting different answers. I need more answers. Ooh, really different answers. Okay, let's back up. Interest is always expressed annually. Therefore, for a 2-month note, you have to prorate it. We're not borrowing this money for 12 months. We're borrowing it for 2 months. So the 12%, the answer you get with 12% has to be prorated for only 2 months. Helena, yes. Helena, sorry, yes. So if you borrowed this money, let me ask the question a different way. If you borrowed this money for a year, what would the interest amount be for 1 year? If you borrow this money for 1 year,
12%.
how much is it?
Oh, the total?
If you borrowed $1,000 for 1 year, how much is interest in dollars if your borrowing rate is 12%?
120.
Yes. So if you're only borrowing it for 2 months, it's got to be less than $120. It's 2/12 of $120. So how much is that?
2%.
How much is that in terms of dollars?
Oh, $20. $20.
Yay, you guys are getting it. Okay. Hooray. All right. So let's go back to. All right. So interest, you take the face value of the note times the annual interest rate in terms of 1 year. So if your note is expressed in months, you just prorate however many months. In our case, it was 2/12. Okay. If you're expressed in terms of days, you can either use 365 as your denominator or 360. Either one is fine. Okay. All right. So I want you, so we're gonna record a journal entry here at the bottom of page 27. Hopefully you wrote in all those answers. Oh, how much will be paid back? The correct answer is $110.20. So you're gonna pay back $1020, $1,000 note plus the $20 of interest. Okay, so let's book all those journal entries. So as I said, sometimes we convert an accounts receivable into a note. All right, so let's say in this example that we just did, Cheesecake said, we can't afford to pay our bill, but we can afford it in a few months and we'll pay it back at 12%. Okay. Okay. So how does Cheesecake, we're going to do how does Chin book this conversion of the account for $1,000 into a note receivable? So let's write the players down for this. This is bottom of page 27. We are doing the books for the Chin company. So Chen Company says, we're converting an accounts receivable into a notes receivable. What is that going to look like?
Wouldn't it be like,
Go ahead, Peter.
I mean, I already got it now. so-
Yeah. So we basically did the same thing we did with a factor. We credit accounts receivable, but we're not factoring it. We're debiting notes receivable. We're setting up a different receivable, one with interest. Okay, so write that in the bottom of 27. We're going to keep working with this example for the next journal entry.
I got one question. So on the line where it says how much will be paid back, you want us to write 20 or
No.
1,020?
I want you to write 1,020.
Okay.
Yeah, thank you. That's a good question. Sometimes when you're working one of these problems, you focus on the interest and you forget you also have to pay back the principal. So when we get to chapter 10, where we have 5 and 10-year notes payable called bonds, you'll go a long time where you're only paying interest on the note, but at the end you have to pay back the principal. So, okay. So does
I'm
everybody,
sorry,
go
I
ahead.
might have missed it, but why is it 1,000 instead of 1,020 for Chen's journal entry?
So this is the May 1st. This is
Oh,
the
okay.
day, this is the day we're issuing the note.
Okay,
Now we're going to record the settlement of the note. Okay, so first we're recognizing the note on May 1st. So now we're going to book, and I don't think I gave you a date. The date here should say on, let's see. No, here's just the calculation. We already did this piece. So you guys already did that. Okay, let's see. Did I get that? No, I didn't get that journal entry. Okay, I don't have a slide for that one. So let's go to your course pack. So we issued the note here. Now, how do we settle this note? And we call it honoring the note. Cheesecake honors the note here. What's the journal entry for Cheesecake to honor the note?
Real quick,
Yeah, go ahead, Peter.
at this point, do they know that like they're not gonna be able to pay on time? So we have to make it into allowance for that.
No, they are going to pay on time. They're just going to pay a few months late. Okay.
Okay.
So now we want to show Cheesecake's paying the note and they're paying the interest. So what is Chin going to record? I'm going to make the journal entry up right here and we can. So how much money is Chin going to record here? You guys already told me how much are they going to get?
$101,120.
They are. Okay. And how do we record that? What account does Chen record for that when they get that collection? So Cheesecake pays Chen. Chen collects the 1,020. What account does Chen charge for the 1,020? Just the first line of the journal entry when any collection is made. What account? The beautiful account. Which one do we use?
Cash.
The beautiful account is cash. Yeah. Okay. So where did I put it? I lost it. Okay, here we go. Did I put it in there? Where did it go? I put the slide in. Sorry, guys. Hang on, let me find it. I put it way down there. Notes receivable, accounts receivable. Here we go. All right. There we go. And Helena, you are correct. All right. So we did that. So we record cash of 1020, Chin. The player is Chin, the company is Chin. Don't lose sight of who the company is. And then what do we do with these other accounts? Notes receivable and interest revenue. How much goes into each account?
So we credit 1,000 for note receivable and 20 for interest revenue.
Perfect, Julie. That's great. Okay. Now that's called honoring a note. Cheesecake could not pay their accounts receivable on time. Cheesecake negotiated to convert it to an interest-bearing note. Chin allowed them to do that. Chin booked the conversion back here on May 1st. Here's the conversion entry, May 1st. And then we calculated the interest. And then when Cheesecake honors the note, you know, that word honor, you know, it's such a popular word now, but it means they made a promise and they kept a promise. That's what honor is. That's what's involved when you honor a note. You keep your promise. So debit cash, clear out the notes receivable, and recognize the interest revenue. Okay. All right. So
Can you go back real quick?
you bet. So just like accounts receivable, and we don't go into that in detail, but just like accounts receivable, companies have to estimate how much of their notes they're not going to collect either. Okay, I'm going to move on. Is that okay? All right. So they have to do all the same thing with notes receivable that we do with accounts receivable. They have to estimate bad debts and all of that and set up allowance accounts. Okay. So notes receivable, collection or disposal. Notes could be held, should be held, mostly are held to their maturity date. The maker may default. Remember, the maker is the borrower, and the payee has to make an adjustment to write it off. And just like accounts receivable, sometimes companies sell their notes receivable. So you just need to know that. We're going to book the journal entries. We've already shown you the journal entry for honoring a note. And we'll do another practice one here. So a note is honored when they make a promise, keep a promise. A note is dishonored when the due date comes due and they cannot pay the bill. And sometimes if you're a geek like me and you listen to NPR or you're listening to the news, sometimes they'll talk about big corporations. And when Kmart was having a lot of trouble, they were saying, well, Kmart's big notes are coming due in February. We'll see if they can honor their notes. And of course, if they dishonor their notes, their stock value goes way down. Okay, a dishonored note is not paid at maturity. A dishonored note is no longer negotiable. So up to the point of the due date, the company that's holding the note receivable, they could turn around and sell that note to a factor. On that due date, that note becomes worthless. Okay. So we'll talk about the accounting for what companies have to do in that case. Okay. Well, let's do a good one. So in the middle of page 28, can you guys do this one? The note was made June 1st. It was a 5-month, 9% note. At the end of 5 months, Sound Entry collects the note, give me the journal entry. We just did a practice one at the top of the page. It's going to be the same journal entry. So tell me what it looks like with different dollar amounts. The note was for 10,000. It's 5 months, 9%. So take a second and set up that journal entry. Or if you have questions, ask me. Okay, who's got the journal entry? What does it look like? You can put it in the chat. Let's see. Oh, we got it. Okay. Yes, Helena. Yes. Let's see. Yes, Helena. Julie, your journal entry is correct. Your numbers are not. Check your numbers. Remember, it's only 5 months. So give me the full journal entry, Tegan. That number is correct, however, for interest. Okay. Ridwan, give me the rest of your journal entry. You got, it doesn't balance. Oh, you got it. You did it already. Okay, I see it. You're correct, Ridwan. Bryce, your first line is correct. All right, let me put up, does anybody need more time? Okay, I'm going to put up the solution. So 5-month note, June 1st, July, August, September, October, November. So the note will be paid November 1st if it's honored. Note receivable is for the face value of the note. We're going to use that term a lot, especially in chapter 10 coming up after chapter 9, of course. So we're going to empty out note receivable at face value. We're going to recognize the interest. Sound equipment is going to recognize the interest of $375, and cash is going to go up by the face amount plus the interest. How did we calculate the $375? Did I show the calculation? I didn't. Okay, let's do the calculation. We would take $10,000. We would take $10,000, and if I can do it right here, times 9% times 5/12. Okay. So that's going to be equal to $900 times 5/12. Okay. All right. Cool. Okay. What if they can't pay their bill? What if they cannot pay their bill? What then? That's called, oh, sorry, one more thing before we get to dishonored. What happens if, now let's go back to the facts. The note was issued June 1st. The note is due November 1st. Okay, What if at the end of September, they issue financial statements and they say, we have to accrue the interest that we earned on this note. As of September 30th, how many months of interest is owed Sound Equipment? Remember, the note was issued on June 1st. So how many months have gone by as of September 30th? You might have to count on your fingers. I always do. How many notes were issued? How many months have passed since June 1st? Honestly, this is probably the hardest thing I'm going to ask you today. Helena, you are correct. Julie, you are correct. Does anybody have a different thought or need clarification? 4 months have passed on September 30th since June 1st. Everybody get that? Because you have to count the month of June, June 1 to June 30th, the month of July, the month of August, and you're at September 30th. So that's a whole month. So 4 months. Okay. So here's how we accrue a journal entry for interest. And if you think back to Accounting 201, this question was your stretch question on your first exam. So we know from the previous slide that the company was going to earn 5 months of interest or $375. But as of June 30th, they're only owed 4 months of interest because interest is a function of time. So how much money is the company owed as of September 30th? You do the same calculation, but it would be 4 here instead of 5. So how much is that? Put it in the chat. Rose, you are correct. Cole, you are correct. Yes. So it's going to be $300. And we would book it as interest receivable, interest revenue. So log that in on page 28. This is if you issue financial statements before a note is due, you have to recognize the interest that your customer owes you. Okay, I'm going to change slides.
Wait, can you explain that one more time?
Which part of it, Peter?
Like the second part, like what the part you just said.
Okay, so if you issue financial statements before the note is due, so this company is issuing financial statements September 30th, maybe they're quarterly statements, okay? They have to recognize how much interest their customer owes them as of this date, September 30th. They're not collecting the money, but they're just recognizing the interest revenue and recording that this money is owed, interest receivable. Okay. All right. And we did that, interest receivable, interest. Yeah. Oops. Now, if we had done that September 30th financial statement, and now we're at the top of page 29, if we had done that, here's where we show honoring the note. Now, 2 slides back, I said, let's go back. 2 slides back, I said, here's how we collect the note. But now I'm saying, what if you had to accrue the note as of September 30th? Then on November 1st, when you actually collect the note, you have to clear out that interest receivable, and you only get to recognize an additional 75 for the month of October. Okay. So that's in a situation where you accrued it, and now you're clearing out the accrual. So jot that down. That'll pop up, I think, on your homework or the quiz. So.
Is there like a specific place with like journal entry boxes to write it down, or you just want?
Yeah, it's at the top of page 29.
29, okay. I only see 3 spaces for that first like box area.
Let's take a look. I'll bring it up.
I can squeeze it in.
Okay. Yeah, squeeze it in.
Okay.
So if I were to number these, I would say let's see. I would say this one would be 1A. This one would be 2A because we're doing a different example. And this one would be 2B. So it's an extension of 2A where we had the note with the accrual. And let's go back to the journal there. Ooh, and you can see from your course pack, we're almost done with the notes. Okay. Okay, so let's squeeze these last ones in. Can I change the slide?
Just one sec, sorry. Okay, I'm good.
Thank
Thank
you. Thanks for, okay. Got a couple more here and then we're done. All right. Assume local burger indicates it cannot pay at the present time. This is called a dishonor of a notes receivable. So we're going back to our first example where we didn't accrue the interest. Okay. Assume local burger cannot pay the bill. If the company does expect at some future date that they are going to pay the bill and they make the decision not to dip into the allowance for doubtful accounts, they will convert that note receivable into an accounts receivable. Why? I'll show you the journal entry and I'm just going to put this up here. Why are they converting this in? So it's the due date of the note. They are going to recognize the interest revenue, but because the note is now non-negotiable, the due date has come and gone, they have to get rid of it. They can't have it on their books as a note receivable, but they can put it on their books as accounts receivable. Notes receivable can only stay on your books if they're negotiable. And if the due date has, and if the note has been dishonored, you have to take it off with a credit. Now, they could just write the whole thing off to allowance for doubtful accounts. The fact that they're putting it into accounts receivable means they believe that the customer is gonna pay them. Go ahead, Cole.
Can they hike up the interest for can they make another note or no?
They sure can, but at this point they haven't. They're just saying
Yeah.
that's another conversation. So yeah.
Gotcha.
I mean, if somebody doesn't pay me in 4 months, I mean, when I worked at Motorola, we had a customer that was delaying payment and delaying payment. You're just kind of hopeful for a while. And then finally they did a what's called a chapter 11 bankruptcy. And that's where they do a full reorganization. And at that point we had to write it off. So it just, you're always a little bit optimistic, but it just depends on your relationship with your customer, how much you trust them. All right. Okay, okay, the last thing I want to go over here is how you calculate accounts receivable turnover. And the calculation is right here. Can I change slides, everybody? I'm doing it. Okay. This is the calculation for accounts receivable turnover. Net credit sales, not cash sales, just the credit sales, divided by average net receivables. And by net receivables, remember, we mean accounts receivable minus the allowance for doubtful accounts. Okay, how do we get average net receivables? This year plus last year divided by 2. And that's in your course pack in the middle of page 29. All right, how do you do collections? 360, how do you do average collection period? 365 days divided by receivables ratio turnover. Okay, so I'm going to put the answers here just to show you what we're doing. So
What
LeBron
page
James,
were those on?
page 29, the same
Okay,
page we've
thanks.
been on. So
No, I mean the ratios.
yeah,
that
page
you-
29, middle of the page. I'll show you. Right there. Okay. I can't wait till we're back in the classroom. I heard that the surge, they're thinking the surge, we're hitting it now. So in the next couple days, we shall see. All right.
Hopefully.
I know, same. It had a beginning, so beginning balance, ending balance divided by 2. Net credit sales, 923,795 divided by average receivables equals 24.9 times. So what that's telling me is about 25 times a year, they're turning over accounts receivable. If the number were 12, that would mean they're collecting accounts receivable about 30 days. But because it's more than 12, it's a lot faster. They're collecting their accounts receivable in 14.7 days. Okay. All right. So what does that mean in practicality? Is that a good news or bad news? You'd really have to compare to your competitors and say, is this good or is this bad? I don't know, but it looks like it's good. Okay. All right. So there's some theory on managing receivables. We'll hit that next week. It's not going to be on your homework, I don't believe. But it's also in your book, and I want to tell some stories on that one as well. Okay, so I want to stop sharing for a second, and then I want to go to I want you to take a look at course groups. All right, let's take a look at that. So I have put you into classroom teams. So if you want to know what classroom team you are in, it is also going to be your project team. So if you go to people, go to your homepage and look at people. And mine looks different than yours. Let me put it on student view. And you go to people and you'll see groups. And you'll see I've created lists of companies that you'll be studying this quarter with the project. Okay, and I have put you into classroom teams as well. Okay, so the companies that I've selected, man, it took forever to find these companies. I wanted to get the financial statements that weren't too weird. I wanted to get financial statements that didn't have a lot of losses. And I also wanted to use, at the end of last quarter, some of you gave me some suggestions on financial statements. Okay, so look at these statements. If you have comments or want to talk about them with me, I'm open for that. And look at and I tried to give you some similarity in your teams, but not complete similarity for those of you that took me last quarter. All right. I have some other ideas for companies if you're not happy with your companies, so let me know. Some of you had asked for project companies involving athletics. Some of you had asked for stuff on cars. A lot of you wanted tech. So I put 2 teams with tech on there. And then some of you had wanted Amazon and Costco, which are like major retailers in our world. Okay, so if you go back to the home page, let's click on the calendar link here. So we'll go here. See if it'll let me do it. Yeah, okay. So your homework is due Friday night. I've told you that I will not be holding Zoom class on Friday, but I will definitely be on email during class time, and I'll be on email all weekend. So if you have any questions that come up with regard to your homework, okay. Your Chapter 8 quiz is due Sunday night. You will need to go into Lockdown Browser for that. If you haven't used Lockdown Browser before, let me know. And then Monday's a holiday. We do not have class on Monday. Okay. So let's go into the quiz here. So what I would ask you to do for chapter 9 is I would ask you on Monday or before we meet on Wednesday to take a look at the chapter 9 videos. Just take a look at the first 2 videos on chapter 9. Okay, so if you're a student and you've never used Lockdown before, go ahead and click on Take the Quiz. It won't start the quiz. It'll say Lockdown browser required, and you'll have to download Lockdown browser. It will not let you download it unless you've gotten out of all your other tabs and you've signed off of everything but the quiz. So just be aware of that. Okay, so don't be afraid if it says take the quiz. You're like, I'm not ready to take the quiz. Give yourself an extra hour just to be safe and do Lockdown browser. Okay, I want to also say last quarter the quizzes were 10 questions. This quarter they're 20. Nope, it says 10. I don't think that's true. Yeah, no, that is true. Never mind. Forget I said that. All right. All right, finally, and we have like 1 minute left. Not really. Go into units and modules. And if you're interested, you can take a quick look at the project under chapter 9. You can scroll down and you can see 202 company analysis project instructions. You can download those and take a look at them. And they're going to basically be very similar to last quarter. We'll go over some of it in class, be similar to last quarter, but it'll be focused on the material from the second half of the book. Okay. All right, any questions?
You said we don't have class on Friday.
Yeah, but I'll be around. I'll be on email. So if you have
So-
any questions, yeah.
No class on Friday or Monday?
Monday's
Wasn't tracking.
Martin Luther King Day, so
Okay.
class is canceled unless you guys want to meet on the holiday. Anybody? All right, but do take, so we do have in chapter 9, we do have a couple of we have about 5 videos. I would ask you to take a look at those videos and maybe watch the first 2 videos, determining asset value and understanding. We've already touched on straight line depreciation, but just maybe have a little review of straight line depreciation. Okay, all right. All right, I hope you guys have a good holiday weekend. I will see you later. And if you have any, stick around.
What time are you available tomorrow?
Yeah, I'll be around tomorrow. I won't be live. I'll be on email.
No. Oh, I'm saying like, is there like class? I'm talking about like office hours.
I don't usually hold office hours on Friday. I hold them Monday through Thursday. But if you email me, I'll look at your email and answer you back.
No, I mean on Thursday. When's
Oh,
the
I'm
office
sorry. I said tomorrow. Tomorrow's Thursday. Yes. My office hours tomorrow I'm having to change them because my dean called me in, but I have, they're typically 1:30 to 2:30, but tomorrow they're going to be 2:15, 2 o'clock to 2:45.
Okay, thank you.
You bet.
Hey Judith,
Yeah.
I wanted to ask you about my letter of recommendation. Because
Yeah.
I know that you were asking me some questions on
Yeah, tell me about it. I still don't understand. I've never been asked those questions before by a company, by a college.
do you mean from your what type of questions are you referring to?
Well, you were making the distinction that I shouldn't mention colleges in the letter of recommendation because you want to use it for multiple colleges.
Yeah,
Did I mention colleges in the letter?
I can't actually check the letter. It would be I have to like write a form, a waiver, so I can't check the letter because obviously some kids would just check the letter and ask their teachers to like rewrite it to make it.
Oh, didn't I send you the letter?
I didn't see it, but like you're not supposed to send me the letter just so that it's fair for everyone.
Okay, so just to be clear, Ran, I've received nothing from colleges.
Okay.
So
You-
you need to put my name in to the Common App and then it'll come to me.
Okay.
And I'm looking at when we communicated, let me make sure of this. I just want to make sure, right? Because I did 3 letters of rec the day I did yours, so I might be blurring this. Okay. Yeah, I sent you the letter. And I usually send students the letter because sometimes you'll catch typos and stuff. So, okay. So I haven't heard from any colleges. Now I've been doing letters of rec for other students And then I just get the communication straight from the college and I submit the rec.
Yeah, I thought I sent you an invite, but it might have glitched out because you weren't aware of it.
Let's check my junk mail. I'm glad you're following up. I don't see anything.
Okay, no worries. I can
Just do it again. Because I've got the letter, it's ready to go, so it should be fine.
okay. Let me really quickly try to invite you and see if you get it.
Okay, that's fine. Cole, did you want to stick around for a minute?
Yeah,
Okay,
I just had a question about what we went over.
okay, that's fine. Let's go ahead, Cole.
Oh, so I was just wondering if you could explain net credit sales, average net receivables, and accounts receivables turnovers,
Sure.
like how you get the average net receivables or the net credit sales.
Let's see, all right, let's bring that up again. Better shut down. So let me look at that. Okay, so you're wondering where the numbers come from or how we calculate? Okay,
Like how do I calculate the numbers for the
Okay.
ratio?
let's bring that up. Okay, so I'm going to share my screen. Okay, can you see that?
Yeah.
Okay, let's see if I can. All right, so use your course pack for this and write this out. Okay. Okay, so the formula is on your course pack, right? You can see it. Net credit sales.
So this is page 29.
Correct.
I just have like the blank boxes. I don't have the explanation.
No, I know that, but
Oh,
you-
okay.
you should have the formulas, right?
Yes.
Okay, that's what I'm talking about. Net credit sales divided by average accounts receivable and so forth. Okay, so let's walk through the calculations. All right, so for net credit sales, the problem has to give it to you. So you can write in 923,795 there.
Okay.
And then for average accounts receivable. Well, you know what? I'm going to stop the recording. What the heck? As well.